My name's Alexis Kokinos. I'm a partner in the tax consulting division or tax advisory group, and I've been practicing in tax for over 27 years. I head up the National Tax Group, and I'm a member of the ATO's National Tax Liaison Group, which meets quarterly with both of the second commissioners. I'm also a chair of the CPA's Tax Technical Committee. And today I'm going to be presenting to you on year-end tax planning considerations for this 30 June 2022. For me, this income year's come very quickly, and there's only about four and a bit weeks until we hit year-end. There's always a lot of things to consider before year-end from a tax perspective, as well as other considerations from a commercial legal perspective as well. This includes just trying to make sure that you've properly considered your tax affairs for this 30 June, as well as trying to ensure that you're meeting all your compliance requirements that you need to complete before year end. Now, for this presentation, I'm going to leave some time for questions at the end of the session, but please, if you would like to raise questions, you can raise them in the question box. And Peter Gillies, who's also online, will try to attend to your questions if it's possible. And if there's any questions residual, I'll try to see if I'm able to answer them as well at the end of the session. Now, due to the limited amount of time that we have in this session to go through year-end tax planning, obviously I can only go through a number of what we call key issues that we're going to touch on today. However, Pitcher Partners, we release a year-end tax planning toolkit every year, which is free to the public and which goes on our website, and that contains a comprehensive list of items to consider for your year-end tax planning. Accordingly, that this should be hopefully released in the next week or so, and hopefully that will provide you with all of the items that you may need to consider for your year-end tax planning. So I'm going to jump into our topics for today. What I will be covering is 4 topics. I'll be going through some general considerations, so areas that you should generally consider as part of your year-end tax planning for 30 June 2022. I will then cover on some items specifically for individuals. I will then touch on trust, which is a major ATO focus area for 30 June 2022 and for future years. And I'll also touch on some company tax considerations as well for your year-end planning. So first area is general considerations. And really what this area is just items that we believe are just standard things that you should be covering for your 30 June year-end tax planning and that you should go through as a part of a checklist. And most of these items and a lot more of these items are covered in our Pitcher Partners year-end tax planning checklist. And generally speaking, the main things would be including, for example, a budget of what you expect your income and expenses to be for you and your entities in the group for this 30 June, and that you properly, when going through that, consider the timing of when you need to bring income to account for the entities and when you're able to claim deductions for those entities and for your own personal affairs. And when we say timing of income, it could be that certain income is reported on a cash versus an accruals basis, or whether you are able to choose a method for your relevant income that you are bringing to account. Obviously, the key risk areas are around large transactions. So if you have had large transactions, a sale of an entity or something else that's occurred during the year, that you should properly consider the tax implications of those large transactions. Prepaying expenses. So if you're able to prepay expenses prior to 30 June, you should consider whether you're able to prepay those and whether you get tax deductions for prepaying those. There are limited opportunities for prepaying expenses and claiming upfront deductions, but they can be reviewed prior to year end. To the extent that you have receivables that are unlikely to be collected, if they are written off prior to 30 June, then you may be able to get a tax deduction for the write-off of those receivables, and that will require positive write-off prior to that time. There's also, for trading stock that's held, trading stock elections, you may be able to take a market value approach or a different valuation approach that can bring to account income or losses if you take into account that other valuation methodology for your trading stock. So it could give rise to bringing to account income or deductions. And you may, for example, bring forward income where you otherwise have tax losses in an entity. So there can be advantages of increasing your taxable income this year under one of the possible methods. The bonuses and accruals, you may be able to ensure that you're able to get deductions for those items by making sure you're definitively committed to those things. And an example would be having a bonus plan that's approved prior to 30 June may give access to a deduction on bonuses. And for accruals, you may, for example, such as audit fees, have certain engagements where they are entered into prior to year end, where you can get access to deductions for the full fees prior to services being completed. So there are action plans that can be taken on both bonuses and accruals, which can bring forward deductions legitimately. You may be looking to make gifts or donations prior to 30 June, which can be tax deductible as well. Obviously, finally, if you are relying on tax losses, it is prudent to consider whether those tax losses are available by looking at the continued ownership tests or same business tests to the extent that they may otherwise need to be utilised for this 30 June. So these are just some of the items that are relevant for this 30 June. Again, our comprehensive checklist covers a lot more and are things that should be considered before your 30 June, before the end of the year. So I'm going to move on to some specific items in respect of individuals and talk through those for your year-end tax planning. And the first, which I think is pretty critical, is to be aware of the tax rates that are applicable to individuals for 30 June 2022, as well as the offsets that are in for this year versus next year. So there's very little movement in tax rates, and they will remain constant for 30 June 2021-22, as well as for the following year, 22-23. So there's very little difference if income is brought into account this year or next year, or if deductions are brought forward or deferred into a following year in terms of tax rate effect. The new income tax bracket, which will take those to a 30% tax rate, will not kick in until the 30 June 2025 income year. As you can see from this table, the low and middle income tax offset that is available for 30 June 2022, but won't be available for 30 June 2023. And we do have the low income tax offset that is available for both years. For the low and middle income tax offset, that's basically a $1,500 potential offset that does kick in at $675 when up to the $37,000 income bracket. Then it increases by 7.5 cents for every dollar thereafter until you get to about $48,000, and then you get $1,500 back as an offset until you hit $90,000, and then it tapers off thereafter. So once you hit about $126,000, you don't get a Lamito thereafter. The low income tax offset kicks in or it stops applying once you earn $66,667. So those are definitely important things to take into account into your estimates of tax payable for individuals, and which takes us to this slide. And this slide is what we call a shortcut or a key slide for determining where an individual will earn an amount of taxable income and not pay any additional tax, whether it's a dividend or where their tax rate has an effective tax rate equal to the corporate rate. So if I look at the first column, and that's assuming it's an effective rate of 30%, essentially, if you're earning $165,922, not consisting of a dividend, you will be paying tax at 30% on that. And that will equate to your general corporate tax rate of 30%, taking into effect or your Medicare levy rate as well. Now, if you receive a dividend of $116,145, that will be grossed up by the 30% credit. It will take you back to the $165,922. But you'll also get a franking credit of $49,777. So effectively, that individual, if they receive that dividend, should not pay any additional tax because they're at the 30% rate. If it's coming from a company at a 25% franking rate, that dividend would need to be $82,398. So that's in the last column on this slide, where it's grossed up to $109,864. And that will provide you with a franking credit to get your tax stack down to zero. Likewise, if you're not earning dividends, if you just earn gross income of $109,864, you'll be on a marginal tax rate of 25%. So these are obviously useful calculations if you are paying dividends or planning to pay dividends from a company and you're looking to minimise the additional tax that you would otherwise pay at those levels, then this obviously gives you a good guide for what those dividends would be. On this next slide, just a couple of things to take into account for individuals that we thought were important to raise. Obviously, people are still working from home and for 2022 and working from home quite consistently as well. And so the ATO have provided, again, concessions around claiming deductions for your working from home expenses. There's really two methods that you can rely on for 30 June 2022. The first is a 52 cent per hour method. So if you keep a record of the hours that you've worked at home, you can claim 52 cents per hour. This method does allow you to claim depreciation on equipment as well, in addition to the 52 cents per hour, but you can't claim it in respect to your furniture that is in your home office. So if you do have a computer, for example, you can claim that in addition to this. But this 52 cent method does cover depreciation on those furniture items, gas, electricity, heating, cooling, lighting, cleaning as well. You can also claim on the 52 cent method your phone, data and internet separate from the 52 cents as well. That being said, the ATO give another method, an 80 cent per hour method shortcut. Essentially, that covers all the costs. So you wouldn't claim those additional items under the 80 cent method. You would just claim a straight 80 cents per hour deduction as a shortcut. And that is available, I believe, for this 30 June 2022, but it may not be available for future years. So it is a shortcut that is being allowed for this year by the ATO. As you may be aware, the superannuation guarantee rate will increase to 10.5% from 1 July 2022. So that may have an impact on income levels for individuals for next year, but not this year. And from a superannuation perspective, I'll just let everyone know I'm not a superannuation expert and I aren't licensed to provide superannuation advice, but just a couple of things that are things of interest around superannuation. Obviously, if you are looking at making deductions for concessional contributions, your maximum contributions can be $27,500. The cap for that for 30 June 2022. And there is an ability for catch-up concessions to be accessed as well, where essentially individuals have a balance of less than $500,000 at 30 June in their superannuation fund. They may be able to access catch-up concessional contributions, but they may be able to provide more contributions to super fund as well for this year. The non-concessional contributions cap for this year is $110,000 as well, which is worth noting. And finally, we just thought it worth noting the downsizer contribution rules for individuals. If you have sold your principal residence or in the process of selling your principal residence, you may be able to contribute up to $300,000 per spouse into your superannuation fund. And for this 30 June, individuals need to be over 65, but after 1 July, they can be 60 years or over and obtain access to this contribution. So as a part of your superannuation planning, this could be a relevant consideration for you if you are disposing of your main residence or have disposed of your main residence recently. So just some things I want to touch on though, which are ATO focus areas for individuals. And the ATO have come out with a number of things that they will be looking at focusing on for 30 June 2022. And it is worthwhile considering that when you're doing year-end planning and putting together your income and deductions for your planning. So the ATO will be focusing on work-related expenses. They do have regard to the work category that employees put themselves on in their tax return. And they do compare the expenses to the industry average and the occupational average for that category. So to the extent that you are deducting amounts in excess of that, you could come under scrutiny from the ATO. ATO are looking at rental properties, mainly around deductions for rental properties and also just the non-commercial rental income from holiday homes are two key focus areas. From a deduction perspective, for rental properties, there are new rules around limiting depreciation claims and travel expenses in relation to rental properties. There's also new provisions around vacant land and claim deductions for vacant land as well. So to the extent that there are rental properties and there is negative gearing, it is absolutely critical to review those new rules that have been in place for a few years now to ensure that you're not claiming deductions that may not otherwise be allowable. ATO are definitely focusing on those areas going forward. On interest deductions, ATO are focusing on the private portion of loans, and this can be very important, for example, where assets have dual purposes like a home or a holiday home, or where you run an office from your home, when you're using offset accounts, or where there's otherwise dual purpose. So that is something to make sure that you are looking over in terms of private use of loans. ATO have come out and they have outlined they will be doing a lot of data matching around cryptocurrency transactions. And they have an ability to track those through their data matching processes. So to the extent that you have cryptocurrency transactions, it is a key focus area for the ATO. And the ATO now have a lot of data around transfer of units and shares through the AIR information that's shared with the ATO. So that's another focus area for the ATO, data matching those transactions. Finally, at GST registrations, ATO will be looking at entities claiming GST where they're not otherwise carrying on a business in their view. So just to keep a couple of things, records are definitely really important. So ensure that you do have appropriate records for all deductions, and that you're keeping those for the record retention period, and that you are checking all of your deductions and the availability of those deductions for this 30 June. Okay, I'm going to move to the second area of topics, and being trusts and some year-end planning tax considerations for trusts. And it's safe to say that trusts are now in the spotlight of the ATO. They have been in the past, but now are critically being reviewed by the ATO and coming under severe scrutiny. And I'll talk to a couple of the key issues in slides to follow. Excuse me. However, just from a trust perspective and from a year-end perspective, the key issues for trusts are ensuring that a trust that doesn't appropriately distribute its income can be taxed at the top marginal rate, being 47%. So ensuring that your trust distributions are effective and are going to the right beneficiaries and are appropriate is a key consideration for any trust for 30 June. And the consequences of getting this wrong can be quite significant from an income tax perspective in terms of the rate of tax that you'll otherwise pay on that income. So there's a general checklist, which is on this slide, which we would encourage you to do for all of your trusts prior to 30 June to ensure that trust distributions are effective. This does ensure that, I will walk through this. Firstly, considering your trust deed and ensuring you understand what they define as income of the trust and who the beneficiaries are of that trust, but also considering the constitution of the trustee. For example, if it's to pass a resolution, can it be done by a single director? Does it need two directors? Does it need other approvals in order to pass a resolution? And there have been cases where distributions have held to be ineffective because rules of the corporate trustee have not been otherwise followed. The trustee may define income in a specific way and may not allow you to change that. So you need to make sure that you've had regard to how it's defined the income that you're about to distribute through the trust, and that you understand whether a particular party is a beneficiary and is not excluded from being a beneficiary. And so having full regard to the beneficiaries clauses within the deed, and that you've picked up whether any additional approvals are required, for example, guardian consent to go to a specific beneficiary. If you're distributing to another trust or another entity, you want to make sure that you've considered whether you've made family trust elections, interposed entity elections, and whether that covers the relevant individual or entity with respect to the distribution. If you need to get franked dividends or capital gains to specific persons, that you've considered the trust streaming rules and whether you will comply with those to ensure that you can stream those types of gains out to those parties. To the extent that you're meeting before 30 June and resolving to distribute, you should be able to evidence that you've met and that you've made resolutions. Doesn't mean you need to have a final drafted resolution in place and signed before 30 June, but you need to evidence that the meeting has taken place. So keeping records of the meeting, who attended, what was discussed, even if it's handwritten, or keeping schedules showing diagrammatically where distributions are going and how they're going, and having those things signed off before 30 June is very important. We do believe that your documentation should focus on what you're intending to happen and ensure that your intention is consistent with the deed. So, for example, if you draft something later on and you misdrafted your resolution, but you can prove that the intention or what was actually resolved in something different, it will help in terms of rectifying or correcting a subsequent distribution minute that might have been drafted or in error later on. So it is good to document your intention and outline exactly what you're intending to do with your distributions. If you're making distributions, you should ensure you're obtaining the TFNs from beneficiaries before the distribution. Otherwise, you can be subject to the TFN withholding tax on those distributions, which is the top rate. And finally, take care on distributions to loss entities. If you're distributing to a loss entity, there can be implications such that the losses are denied to those entities through income injection rules. So you need to ensure that you've looked at the income injection rules and those losses are otherwise available for such distributions. Okay, so that's the general checklist for trusts. Now getting into the specifics in terms of issues the ATO are targeting. So you may have heard that the ATO is targeting trusts through a provision called Section 100A. And 100A has been in our legislation since 1979, and the ATO have not really put out much on their view on 100A and what they'll do around 100A. They now have released a number of documents on Section 100A, which includes a tax ruling, a practical compliance guideline, and a taxpayer alert. Now, the first two documents are in draft and have not yet been finalised, but they've put out their preliminary views on those, and they've put out a very broad view of when Section 100A would likely apply. And essentially, Section 100A, if it does apply, what it does is it turns off the distribution to beneficiaries. So it says those beneficiaries are not entitled to the income. And given that the beneficiaries aren't entitled to the income, it means that the trustee then pays tax at the top marginal rate on those distributions. One big concern of this is that the ATO have an unlimited amendment period on 100A, so they can go back technically to the start of these provisions in 1979 and apply it for every year thereafter. So they aren't subject to the normal 4-year amendment period. And one of the big things that have changed in terms of the ATO's view on this provision is there's been exclusion for ordinary family or commercial dealings, and the ATO have not applied a narrow view of that exclusion, but they have come out now with a narrow view stating that the ordinary family commercial dealings exclusion does not really apply, in their view, to many what we would call ordinary family dealings. And thus, they are seeking to apply 100A on a more broader application to taxpayers. So they have a tax ruling which has a technical view on their view, which is very hard to follow. And they have then a practical compliance guideline, a draft practical compliance guideline 2022 D1, essentially, which is equally as hard to follow. But what it tries to do is tries to provide some transactions or arrangements and an ability to classify arrangements into what they call zones. They have a white zone where the ATO won't provide any compliance activity, and these are generally around transitional arrangements. And then they have a green zone for arrangements post 1 July 2022, where if you meet the fact pattern of the green zones, they won't dedicate compliance activity to that. They'll just confirm the categorisation. They then have a red zone where certain arrangements they say are high risk of ATO compliance activity, and they will consider applying 100A to those red zones. And then you have arrangements that don't fall into any of those, and they call them blue zones arrangements. And the ATO, in a review, will look to better understand your arrangement to ensure that they shouldn't apply Section 100A. So that's what the ATO have released to this date. So what is 100A? Just in a nutshell, what 100A tries to do is it tries to look at the trust distribution to individuals or to parties or entities. And it essentially looks at whether a benefit is provided under an arrangement to another person who's not otherwise that beneficiary. There needs to be a tax benefit with respect to the arrangement. So generally, if that party who's provided the benefit would have paid more tax if they received the distribution, generally speaking, you should will find there can be a tax benefit. And a benefit is very broadly defined. It could include an interest-free loan, it could include a gift or some other transaction that otherwise benefits another party. And the party can be the actual trust that made the distribution. I got to retain the funds in the trust and not pay out the distribution. So the ATO has taken a very broad view as to when this provision can otherwise apply. Now, this arrangement is just on the screen where you have a family member that's presently entitled to income, and then you provide an interest-free loan to a higher tax person. The ATO have this one covered as a red zone arrangement. Now, that would be where the parties were not married or weren't spouses and don't share common bank accounts. This arrangement can be classified as a red zone arrangement. And the ATO could seek to dedicate compliance activity to tax this arrangement at 47%. So I'll go through just a basic example that may come up in year-end planning and just outline the Section 100A and some of the risks around Section 100A when looking at the ATO's guidance documents that have come out. So assume in this group I have an income trust that has some income that we're expecting. We have a loss trust, so we can quantify there's a loss there. And we have some individuals and a corporate beneficiary within this group. So for year-end planning purposes, we may decide that we'll distribute our income to a loss trust and soak the losses up. And therefore, we've utilised those losses. And as part of that process, for example, we may have some excess distribution. So the income may be greater than those losses. So that loss trust may look to distribute that excess income, and it may take those to individuals and it may distribute to them up to their, basically an amount to get them up to their 30% tax rate or their top marginal rate. So there can be some tax planning around those distributions, and with the excess of income going to a corporate beneficiary. In addition to that, the corporate beneficiary might seek to pay a franked dividend to a certain individual in the family group, and individuals in the family group may make interest-free loans to other members in the family group, and that may be, for example, to repay a loan back to the loss trust. And this is just an example. It's not intended to be indicative of anything, but other than going through some scenarios that may occur. So if we look at the ATO's PCG, pretty much any of these transactions could fall into a high risk zone under their PCG. The utilisation of losses, the ATO has a red zone that covers the distribution to loss entity. And essentially the way that red zone works is if the distribution goes to loss entity and any party other than the beneficiary benefits from the distribution, then that can fall into a red zone. And so there is an amount being distributed to loss entity, so you would have to have regard to what's happening with that dollar amount. Is it being retained in the income trust? Is it being applied? The loss trust, is it being offset against loans to take yourself out of that red zone? With the distribution to the corporate beneficiary, there's a potential for that to be in a green zone, and I'll cover that later when funds are retained in the trust. But that does come with a number of criteria that otherwise need to be satisfied. For example, being placed on Division 7A terms, and then also using the money that's retained for certain purposes. There's distributions to individuals in this example, and again, one would need to have regard to the tax rates being paid, but also what is being done with the money. As you can see in this example, there's an interest-free loan being paid to another party or being made to another party, and so you would have to have regard to that. That can be a red zone arrangement, as I've described in a previous slide. And finally, there has been a franked dividend paid out of the corporate beneficiary that has gone to an individual who will get access to those franking credits, which using that money to repay back to the loss trust. And again, that could result in a tax benefit that otherwise may fall into a risk zone under the PCG. So there's a lot of things that are happening within this. And for 30 June, once you've done your year-end planning, it is worthwhile having regard to the ATO's PCG documents and looking to whether any of those would be high risk and whether you can enter into practices that could reduce your risk for your 30 June distributions. So this next slide is intended to show you what the ATO has covered as a green zone example, where they say they won't dedicate compliance activity. So in this example, they have a distribution that goes to a company. Now, from the trust, they say that it must be individuals, an individual, their spouse controlling the trust, and the individual controlling the trust must control the company in this example. So the trust may distribute the income to the company and get access to the 30% or 25% tax rate. And in this case, it may retain the money in the trust. So to the extent if they use that money for working capital purposes or invest that money into an asset, an investment asset that otherwise generates income, then in this example, the trust distribution to the company may not be within Section 100A, may be in the green zone under the retention of funds example. Now, there can be no benefit provided to any associate in any way, such as a non-commercial use of the property. So if you bought a holiday home and individuals use that for personal purposes, that would not be covered currently in the scenario potentially. So this is a green zone example, and safe to say that the PCG has very limited green zone examples at the moment. So where does that leave us for this 30 June with respect to distribution? So the ATO yesterday held a meeting on Section 100A as a part of the stewardship group, which I attended. And what the ATO have acknowledged is there's been significant submissions put out on 100A, Section 100A by the relevant parties, and the ATO are looking over those submissions and they are going to consult on those submission points. Essentially, from that, though, they're not going to be able to finalise their documents on 100A before 30 June, and it's probably going to be some time that they're going to take before they finalise that. So it would probably be more close to the end of this calendar year that we'll see finalised guidance. We also have a case called Guardian's case that is covering Section 100A, and it may itself be decided before the end of the year, and may in itself hold 100A to have a wider or a more narrow focus than otherwise the ATO are taking. So what do taxpayers need to do for this 30 June? Well, we do have a 2014 fact sheet that has been released by the ATO. It has very limited guidelines, but does have transactions within that fact sheet. To the extent that you follow the fact sheet and have an arrangement covered by that fact sheet for this 30 June, the ATO won't be dedicating compliance resources to those types of arrangements. So that is something that can be done for this 30 June. There's limited green zone examples for this 30 June that you might be able to come in with, but it is worthwhile having regard to those green zone examples for your distributions for this 30 June. You could also ensure that the entitlements to the beneficiaries are paid out to those beneficiaries or applied for their benefit, i.e. you pay expenses that are legitimate for those beneficiaries. So that is a key consideration for this 30 June. ATO have indicated that's an area where they won't seek to apply 100A. Now that's legitimate expenses. So the ATO's taxpayer alert did cover scenarios where you had child beneficiaries where the parents had put through loan accounts for the children covering their previous expenses in relation to schooling, etc., where the ATO do not believe that they're legitimate expenses that would otherwise be paid on behalf of the children. So you just need to be careful in terms of what expenses you are paying on behalf of the beneficiary, but to the extent they are legitimate expenses or liabilities of the beneficiary, or if you're paying the actual cash to the beneficiary, obviously those scenarios will be lower risk with respect to distribution. And where there are significant timing differences between accounting and tax, so if accounting distributions are different to the tax distributions, there's a heightened risk of 100A applying in those circumstances where it provides a tax benefit, where there's distributions to corporate entities such as no top-up tax being paid on those arrangements. To the extent that you have those definitely should be looked at with respect to 100A prior to 30 June. So moving on from Section 100A, another key area that we see can be often missed prior to 30 June, but can be actioned very easily before 30 June, occurs where you have trusts that are the operating entities and have taxable income, and where expenses are being incurred in a management entity which doesn't otherwise charge fees to those trusts. And in those cases, you may have the income distributions being distributed to the management entity to soak up the losses. Now, there has been a tax determination, 2018-9, and a case Chadbourne, which has come out and said that those amounts, those expenses are non-deductible if all you receive is trust distributions. And so this could create a risk if you are doing that for your 30 June distributions. The easy way around this is to enter into a management agreement prior to 30 June and charge an appropriate management fee down to those trusts, which would have the effect of bringing to account income legitimately in the management entity. For that to be effective, you would need to have the agreement in place before 30 June and have an appropriately considered management fee such that it does follow what would be the otherwise ATO guidance on charging management fees. So it's something that can be actioned pre-30 June if detected before that time. Otherwise, it's very hard to action this post-30 June. Finally, I just wanted to highlight that there is a lot of ATO scrutiny on trusts and the compliance activity around trusts is becoming greater. So it is worthwhile considering for many groups whether it is possible to restructure a group from a trust to a corporate type structure. And moving to a corporate structure, there can be simplification from a tax perspective. You don't need to do trust distributions from multiple entities. You can form a tax consolidated group. You can offset losses between them. You may have access to a lower tax rate for corporate groups that carry on business if they meet a certain dollar threshold. You may have a simpler Division 7A because the loans may be intra-group, and you may have just one loan out to family members that can be managed from a Div 7A perspective. You may also get access to CGT concessions on the sale of shares or a sale of business assets. So it may be an option to run a corporate group rather than a trust group on a go-forward basis, which may reduce a number of risks, including the risk of Section 100A, obviously, by retaining the income in a company group, where 100A may not otherwise apply. Obviously, getting into a restructure, there are tax consequences for restructuring that would need to be considered, including stamp duty, funding certain transactions or moving funding into a corporate vehicle, and certain contractual arrangements that might otherwise have to be shifted if you were restructuring. The other key advantage of using a trust is that you may not need to report your financials to ASIC, whereas if you restructure to corporate group, you may have to report your financials to ASIC if you meet certain thresholds. So not saying that a corporate group is for everyone, but it could be something that you consider if the complexity of trusts are becoming too hard and you're looking for a simpler structure going forward. So something definitely to consider into the new year. So that's it for trusts. In terms of this presentation, I'm going to now move to companies and just some year-end tax planning considerations for companies. And a key focus area again for ATO is the compliance with Division 7A. So Division 7A applies to loans that have been made by a company to the shareholders or associates of those shareholders. And it can treat those loans as being an unfranked dividend if they do not comply with the requirements of Division 7A. And that includes either having those loans repaid back by lodgement time of the company's returns or putting them on complying loan agreements. So for this 30 June, it is absolutely critical to identify potential Division 7A arrangements, but to go through a checklist to make sure you've complied with Division 7A just due to the consequence of having unfranked dividends to the extent that there's been loans provided. So the benchmark interest rate that you should be checking for 30 June 2022 is 4.52%, and that you're ensuring that your minimum loan repayments comply with that interest rate for this year. It's absolutely critical to identify the transactions that are otherwise occurred from the company to those shareholders or associates, being loans, payments, or debt forgivenesses, and that you do have appropriate loan documents in place by the requisite time to make sure that you don't trigger deemed dividends. If you're using sub-trust arrangements, make sure you have your investment agreements in place. And to the extent that you have to do minimum loan repayments on prior year loans, that you've made them by the appropriate time that they need to be made so that you don't have deemed dividends on the loan repayments that are required. To the extent that you need to make repayments and you don't have enough cash with the shareholders or other entities to make the repayments, consider franked dividends and that you've declared them before 30 June and that you have records that those dividends are being declared. Obviously, if you declare them after 30 June, they won't be sufficient. And you may have unfranked dividends otherwise. You've got to be very, very careful about reborrowings, ensure that they don't occur. So if you've lent to an individual and they repay that loan and you re-lend to the individual, you could be caught in the reborrowing provisions, and that may apply through interposed entities. So if you have a lending through another interposed entity back to the same individual, it could be potentially caught for Division 7A purposes. And finally, just make sure you are considering transactions going through interposed entities. So a company that makes a loan to another company that's not caught within Division 7A, that may make a loan to an individual, which it may be caught under the interposed entity rules, so that you're considering the interposed entity rules right through your review of Division 7A. So that's just a helpful checklist that we think is at least the bare minimum that you should be looking over prior to 30 June to make sure you've complied with the requirements of Division 7A for your year-end tax planning. Now, something worth noting, though, is the ATO have come out with a draft determination, tax determination 2022, D1, which is going to again change the treatment of distributions to corporate beneficiaries. So the history of this one has been that from the start of Division 7A all the way up to 2009, so December 2009, distributions to corporate beneficiaries that remained unpaid were essentially excluded from Division 7A. On the 16th of December 2009, the ATO came out with a view saying that they would otherwise be treated as loans unless you place them on what they called a sub-trust arrangement. So they only applied to new distributions after that date, and they could become loans if you just left them unpaid, or if you put them on a sub-trust arrangement, you could put them on a qualifying sub-trust arrangement, which could be a 7-year, essentially interest-only loan, or a 10-year interest-only loan. So that view had held, and there was a Treasury announcement that they were going to change that legislatively to make all unpaid entitlements loans for Division 7A purposes, which has now, the Treasury had announced previously that they still have that amendment on their list of items, but there's no date when that amendment will come through. So the ATO have taken upon themselves to put out a tax determination, which essentially says from 1 July 2022, any new distributions after that date will be treated as loans from a Division 7A perspective, and there won't be any exceptions with respect to the new distributions. So it does mean that this 30 June 2022 is the last year which distributions, unpaid distributions, can be put on a sub-trust arrangement and which may get access to the interest-only option for Division 7A purposes. So it does provide a special funding type from companies to trusts if you can get access to these rules for 30 June 2022. In addition to that, there is a PCG 2017-13 that says that for those arrangements that were put on sub-trust arrangements, when they need to be repaid at the end of the 7 and 10-year term, the ATO has allowed those to be put on Division 7A terms. And they've extended that every year on a year-by-year basis for the new UPs that are ready to be refinanced. Verbally, the ATO have told us that they are looking to extend that to all UPs up to this 30 June, but it has only been verbal confirmation, and we haven't seen that in writing yet. Essentially, if they do that, we not only get access to the sub-trust arrangement, which may be an interest-only arrangement, just say it's 10-year interest-only arrangement, but it may give you access to then a Division 7A loan thereafter, which is approximately 7 years. With the 1 year, provided to you to put that into effect, essentially this can give you access to an 18-year arrangement between a corporate and a trust at a very low interest rate, which gives you access to financing for that period of time if the ATO extend that PCG. Maybe to demonstrate what that otherwise means as a last time that this may be offered to taxpayers, we may have some income trusts within the group. We may have an asset trust and we may have a corporate beneficiary. You may have the income being distributed to an asset trust, a collective asset trust, so $100 coming in from each of the two trusts into an asset trust. The full amount of $200 may go to a corporate beneficiary. You may pay tax at a 25% rate or a 30% rate. And that amount may be unpaid and put on sub-trust, so an interest-only arrangement to say it's put on for 10 years. You may use that to refinance or finance an asset held by that trust for $200. And that may be put on potentially a 10-year interest-only arrangement. At the end of that 10-year arrangement, you may be able to put onto another 7-year Division 7A loan arrangement. May provide a total of 18 years of a financing arrangement for a capital appreciating asset. Now, obviously, I went through 100A earlier, and you would need to consider Section 100A with respect to this arrangement. And high level, the ATO have outlined in the fact sheet and in their PCG that to the extent that you comply with Division 7A with a corporate beneficiary and invest that into an investment asset, that this may be a lower risk of 100A applying in this circumstance. Now, unfortunately, neither the fact sheet nor the PCG cover exactly this arrangement. The fact sheet covers a sub-trust arrangement, but requires it to be put on working capital. The PCG only covers Division 7A loans and allows it to be put on an investment asset. But if you put the two together, hopefully you should come to the conclusion that if it's a vanilla arrangement such as this, that it's used for funding an asset, an investment asset, and there's no benefits provided to anyone else, that this hopefully should be of low risk of ATO applying Section 100A. So again, this could be a very useful funding mechanism that may be accessible for this last 30 June 2022. Just some last things to mention for companies. So in terms of deductions for this 30 June and depreciation deductions, really the only remaining depreciation concession for this 30 June 2022 for new assets or secondhand assets is a temporary full expensing method. The against asset write-off and the backing business concession is generally not applicable in terms of the extended depreciation claims for this 30 June 2022. And you'll be looking at temporary full expensing. There are obviously criteria to get into those provisions, but to the extent that you can claim them for your businesses, you get access to 100% deduction. For small businesses that use use a simplified depreciation, you cannot opt out of it. It is compulsory. Extent that you're not using simplified depreciation, you can make an irrevocable choice to opt out, and you may wish to do that so you don't create losses that you otherwise have to carry forward and satisfy a continued ownership test on as well. So definitely that is something you should be reviewing, depreciation claims, and if you are looking at making capital intensive acquisitions between now and 30 June, you may look to see if you bring those forward, and you obviously need to have those installed ready for use by a certain time to get access to those depreciation claims. So also the criteria for getting access to those depreciations should also be considered before 30 June. What goes hand in hand with that is the access to the temporary loss carryback provisions. So these provisions for companies allow you to take a loss that you may otherwise incur, for example, for this 30 June 2022, and carry that back to a year that you paid tax, which may be an earlier income year, 2019 onwards, and offset that against the taxable income of those years and claim a credit back, essentially, or an offset back. And the offset is limited by your current franking account balance at 30 June this year. So obviously there's some planning opportunities there. If you're looking to pay a dividend and you don't need to pay those and you want to retain your franking account and get access to loss carryback, that could be something that you need to do for this 30 June, whereby you might get access to essentially 30% of your tax losses back as a tax offset, which can help fund asset acquisitions and other things. And to the extent that you are acquiring assets and taking yourself into a loss position and getting access to temporary full expensing, again, those can be utilised for the loss carryback measures. So absolutely something to be looking at for this 30 June 2022. The measures will be available again for 30 June 2023 as the last year to which these provisions can apply. The next slide just is a summary of the tax rates just for this 30 June and the franking rates. It's quite simple for this year. We do have a default corporate tax rate of 30%, again for this 30 June 2022. But if you get access to the reduced rate for basically business taxpayers or those that have more than 20% of their turnover with respect to non-passive income, then they can get access to a 25% rate. You do need to have aggregate turnover of less than 50 mil for the current year and get past that passive income test to get access to that rate. And when franking dividends, you do need to look at your franking rate that's applicable for dividends coming out. It is possible to have a franking rate at 30%, even though you might be taxed at 25% this year, because it does look at your aggregate turnover for the prior year. So you might have higher turnover in a prior year and have to frank at a higher rate. So you can have a mismatch of tax rates within that. It is worthwhile considering this, especially if you are paying dividends out for 30 June this year, or if you think you're paying dividends on the 1 July next year, there could be a differential of rates that might otherwise apply to those dividends. And finally, I'll just touch on a few focus areas for companies before finishing up on this topic. So the ATO, as I've mentioned, are coming out with, are looking and focusing on a certain number of things for private companies. One of the key areas is Division 7A and private use of business assets or private use of funds in a company. So they are becoming quite stringent on Division 7A and are focusing on that on any ATO review. So it is pretty critical that you are reviewing Division 7A for any corporate entities that you have in your group. If you are consolidating or have tax consolidated groups, they are focusing on how you've applied the methods of consolidating. So how you apply what we call the push down to new assets, resetting the cost bases. And if you've had losses that you bring into the group, how those losses have been brought in, what are the available fractions for those losses, and how those losses are being utilised by the group. On international transactions, they do have data matching on international transactions, which they are checking up on. So they are focusing on your failure to report on transactions or if you report them incorrectly. They've come out with a couple of alerts around those accessing the lower company tax rate by artificially accessing those, so entering into arrangements that may inject income or do other things that might artificially create a lower tax rate in a corporate. So it is something to be very, very mindful for your 30 June distributions for trust income, or if you're paying dividends through companies that have flowed through to other companies that might otherwise give you access to a lower rate. And finally, they have outlined that they are still focusing on property developers and transactions that property developers are treating as capital gains. And ATO's view is that it's very difficult for property developers to access capital gains, so they are scrutinising those that are reporting capital gains in their tax returns where they are a property developer or associated with property development. So that comes to the end of my presentation. I'm going to open up for some questions, and Peter, I might open up to yourself to see if there have been some questions raised during the session or any comments that you wanted to raise at this point.
No unanswered questions, Alexis, no.
Oh, okay. Excellent.
At this stage, anyway.
No problem. Must have been a comprehensive session. Well, that takes me to the end of the session. Again, I'd just like to highlight for 30 June 2022, there's a lot of activity there that the ATO mentioned they're focusing on, which has been business as usual stuff, trust distributions, Division 7A. So it is critical that you are considering your tax planning affairs for 30 June, minimising risk, as well as making sure that you're ensuring your compliance is in order for 30 June 2022. We will be having our comprehensive toolkit that comes out over the next week that will be available to you. And I'd encourage you to reach out to your Pitcher Partners representative to talk about your year-end affairs prior to 30 June to make sure you've got things covered for yourself. Again, I'd like to thank you for your attendance at this session. The session has been recorded and will be sent out within 3 business days. So thank you very much for attending and have a great day.